Lucas Real Estate Podcast here. We're doing podcasts and not videos because it's fun, it's quick, it's easy. We're just going to do a very quick recap of understanding the capital gains exclusion. It's the IRS Section 121 exclusion, aka the Homeowners Exemption, aka the Homeowners Exclusion, which saves you up to $250,000 for single people, $500,000 for a married couple filing jointly. So real quick, head on over to our website, lucasrealestate.com, for the full article and additional information. That's Lucas, Lucas, -real, REAL, -estate, ESTATE.com. You can subscribe to our newsletter, subscribe to this video, all that kind of good stuff. But real quick, to get into it, it's very simple. If you have been residing in the property and owned the property for 2 of the prior 5 years, with lots of exceptions. See our article for additional information. It links to some IRS publications as well. But basically, if it's been your primary residence for the last 10 years, you're easy, right? You go to sell that house the first, and you're a married couple filing jointly, for example, the first $500,000 of capital gains is free. So let's say you bought the house for $700,000 and you now sold it for $1.7 million. Well, basically, in its simplest terms, you've made $1 million in profit. You've got some deductions you can take off that. Obviously, your realtor expenses, your closing costs. If you've done some certain home improvements over the years, we've got some of those listed in the article. You can take that off as well. But in this example where you've made $1 million in profit, you're a married couple filing jointly, you get to take that first $500,000 in capital gains, and that's the IRS 121 exclusion. You get to just throw that away. But now you still have that $500,000 difference left over that you are going to pay capital gains tax on. And that's a big number. So that $500,000 is going to bump you up probably into the biggest brackets, both in California and on the federal level, plus the Obamacare. You're going to end up paying basically 37.1% taxes on that. So that's a significant number in that hypothetical. But that $500,000 can be great. Let's say, for example, you've only lived there for 3 years and you've only made a $400,000 profit when you go to sell the house. Then perfect. You're going to be paying absolutely zero capital gains taxes because the number is going to be under that. There are some rules. You can, in theory, have lived in the property 2 years ago, rented it out for 2 years. That's fine too. The rule is, again, that you have to have lived and owned in the property 2 of the prior 5 years. There's some fun ways this can also be used in conjunction with 1031 exchanges that we go into in some of our articles. And then there are some exceptions. Maybe you're in the military and you had to go off on deployment. We thank you for your service. And then that obviously does freeze the time frame as well. But that is basically the issue in a nutshell. So head on over to our website for additional information, or you can reach out. We do appointments. We do charge to do 1-hour consultations. Some people find that helpful. We also do buy and sell real estate here in the Newport Beach and Orange County communities. So if we can assist you with that, that's great. You get all of our services rolled into one. But otherwise, we do offer the advice and consultation on an appointment basis, and we've got plenty of information there on our website, lots of articles, and then links to some additional sources, such as some of the official IRS publications. So that's it for now. Please feel free to subscribe to this, subscribe to our newsletter, which you can find on our website, and we'd love to get you additional information, and take care.